Hi guys, welcome back to another video. As you can see from the title, today I'll be looking into the recent earnings of what I call the mother of all REITs, Ascendas REIT. So when it comes to investing, I always try to be critical in the different investment to come up with the pros and the cons. From there, we can really determine at what reasonable valuation it is for us to be comfortable to buy in. Because investment is always putting in your hard-earned money, so extra work must be done in order to invest correctly to achieve financial freedom that I'm sure everyone want to achieve. So in this video, I'll flag out the good and the bad stuff that I can get from the Q3 business update for Ascendas REIT. So let us dive straight into the key highlights. So for Q3 highlights, there are a lot of values that are always missing. As I mentioned before, Q3 highlights business updates do not actually really give a lot of values. So we'll try to extract as much as possible from the results itself. So if you have been following the news with the rapid rise in the interest rate and the currency madness, my focus will be on their leverage ratio and the hedging of the currency. So for people who are new to Ascendas REIT, I call them the mother of all REITs is because they have properties catered for every different industries and properties in Singapore, Australia, United States, Europe and UK, with majority in Singapore. And they also have a strong sponsor, which is CapitaLand, the shopping mall that I'm sure everyone knows about, and every company that works in would most probably give these vouchers as appreciation token. So I guess the only places which they do not have is Japan, Korea or China. Okay, so why do I say that it is very important to monitor the currency and the leverage ratio? If you have been following closely, US dollar has strengthened a lot due to the constant rise in interest rate. And I guess if you have been traveling recently, you'll realize that the countries that you go are most probably much cheaper because of the strong currency of Singapore dollar. It's because MAS have been strengthening the US along with the US dollar, and it's good for us to be spending the money. But it's very bad for the REITs taking in as the income, because they have to take in the income as the respective country's currency before and convert it to SGD before it is distributed to us as dividends. So because the drop in the weakening of the currency, this would naturally convert to a lesser amount of SGD to be given to us as a dividend, which thus decreasing our dividend yield as well. Therefore, currency risk on top of interest rate is definitely there. Okay, so as you can see from these slides, they have a proposed acquisition of two new buildings, which is one high-tech industries and one cold storage logistics, which I'll explain more later. So for the capital management, which is mostly about the currency and the leverage ratio, the leverage ratio is at a healthy of 37.3%. However, it has went up, as you can see, from the 36.7% to 37.3%. It's because of the recent acquisition, so it makes sense and it's okay. However, for the currency hedge, they have been maintained at 75%, which we will look deeper into it later. Okay, then one of the things I like is that the portfolio rental reversion has went up by 5.4%. Moreover, they have also managed to bring up the occupancy rate by 0.5% to a very high value of 94.5%, which is very impressive given the uncertainty in the economy. This also means that their properties are still attracting tenants as well. Moreover, they are also making two property purchases, which are my favorite sections, which is the industrial and the logistics segment. And the management is very smart in purchasing the two new properties slightly below valuation with good location and occupancy. So for the industrial building, they have purchased it at a valuation of 104.8 million, whereas the building valuation is at 111.5 million. So this is what I actually like to see from REITs or management, where they are buying good assets at a cheap valuation or a cheaper valuation rather than overvaluation. So, moreover, they also have a reasonable land lease of 21 years because Singapore do not have freeholds or rarely has any freeholds. Moreover, they also have a very good occupancy rate of 95.7%, and the NPI yield, which is the net profit income from buildings, to be 7.2% pre-transaction cost and 6.8% post-transaction cost, which is a very reasonable value. So the next one is the logistics side, which is also my favorite. They have also purchased at 191.9 million, whereas the valuation comes in at 195 million. This land is also 21 years remaining with an occupancy rate of 100%, and the post-transaction NPI of 6.9%. So these two buildings are expected to be completed at fourth quarter of 2022 or first quarter of 2023. This is a very good value because this, as you know, new assets means what? Means higher dividend. So with these acquisitions, we do expect the leverage ratio to go up. So let us look at the debt structure as well. As you can see from the values, they have increased from 37.3% to 36.7%, but it's also at a very healthy range because, as is stated here, the MAS limit is at 50%, so they have actually a lot of buffer rooms to play about. However, my concern will be on the interest coverage ratio and the fixed cost of debt that they are paying at the 2.2%. From my previous video with MIT, their management have flagged out the risk of the spike in the debt percentage required to be paid when they refinance, which will also be a concern here as well, which I will elaborate on later. Okay, so one of the slight advantage that Ascendas has over MIT is that Moody's rating is very important in determining how much you pay for the interest of the debt. As you can see, they are rating at A3, whereas compared to MIT previously is rated through Fitch at BB3. So let us look at the chart to see the difference. So if you look at the chart, Ascendas is considered A3 at the high credit quality with low risk, whereas for MIT in Fitch ratings is considered a BB+, which is good credit quality with moderate credit risk. So what is the difference between this one grade? Well, so what does the rating actually means? So the rating actually determines how safe is your assets for the banks to loan money to you. So if you are a higher rating, this means that banks will loan you at a lower interest rate, therefore giving the REITs a slight advantage. If you look at the debt maturity profile for full year of 2022 and 2023, about 20% of the debts will be required to be refinanced. So that's what I mentioned about, is the risk of when they refinance this huge amount of debt. So whether we will see the increase or how much they'll increase will be seen in the next few quarters. The impact of the increase in interest rate can be seen from the risk adjustment table. I've noticed that there is some difference between the last quarter and this quarter, which can be seen from the pro forma DPU impact. As you know, the previous quarter for 50 BPS or 0.5% increase by the Fed or by in general would result in a drop of 0.15 cents, as compared to now, which they are actually announcing a higher impact on the DPU of 0.17%. And we also can see that the hedge of the borrowings dropped by 2% because of the extra amount that they had to loan to purchase the new property. So what we can assume from here is that they actually brought the new loans unhedged. Okay, so what can this actually tells us about REITs in general? It's always important to take a buffer in order to make sure that this kind of situation do not affect your valuation when it comes to buying the REIT. So currently, different currencies are hedged. As I've said, since Australia, pounds and euro are dropping, their debts should be okay. As you can see, the natural hedge of this and pounds and euros are at a respective decent valuation. However, my focus will be on the US dollar hedge itself. As you know, US dollar are increasing very rapidly in terms of the currency strength. Therefore, it's important that the management knows how to balance it, as it will fluctuate given the uncertainty in the environment. So we will continue to see how the valuation will change or the hedging will change along as is being affected. Okay, so similar to last quarter, occupancy have been doing well. Only the US and Singapore are seeing a slight decline in the occupancy rate, which can be negligible as well. So if you look at the SG portfolio, they mentioned about a 51.6% occupancy, and you might be wondering, how come there's this very low value when the normal occupancy rate is at 92% and 91.8%? So this value here might sound a bit confusing, but this value is dependent on the occupancy rate of the new assets they have purchased from the last 12 months. So because for June 2022, they are still including a new acquisition of the Grab headquarters, which must be at a very high occupancy rate. Therefore, for this quarter, they only include a new acquisition, which is UBIX, which has a very low occupancy rate of 51.6%. Okay, so what is this UBIX property? So UBIX property, as you can see from this design here, it is a industrial hub which is just TOP in January of 2022. Moreover, it's very near UB MRT or right at the doorstep, which is a very attractive place to give tenants to rent as well. So I'm quite confident that in the long run, this occupancy rate will continue to go up. However, in the short term, this 51.6% is actually a very important value. If we compare to the previous results of the second quarter, they mentioned about the sharp increase in occupancy for this property from 18% to 51.5%. However, why would the occupancy only increase by 0.1% from Q2 to Q3? So that is something that is very questionable, and we do not know until further details are being elaborated. We will have to focus on this part for the next quarter to see if there is a more improvement, as the property should be able to attract better tenants given its location. The rest of the occupancy is fine with nothing much to update, and you can glance through yourself from the different countries as well. So next, let us look at the tenants chart. So looking at the chart, it shows how diversified Ascendas REITs have been. I've always been so impressed, and it seems to have added more industries. As you can see, there are additional ones compared to the previous quarter, such as conglomerates and governments and IPOs, NGOs or MPOs. So they might have split out on different industries, or they have added or gotten the opportunity to have all these as tenants as well. Looking at the portfolio lease expiry profile, I like how the management keeps it simple by mentioning that new leases renewed for those tenants this year, as you can see from the new lease here, we signed in Q3 of 2022, has increased by 5.4 years, which is very impressive because this actually shows that tenants do want to stay. However, they have much more work to do because 25.7% of the tenants are going to expire in full year 2022 and 2023. and this might be a slight concern considering next year we might go into recession. I definitely hope to see these two values actually drop in the subsequent quarters as well. Okay, so on the bright side, most of the recent next 2 years lease seems to majority comes from Singapore expiry lease as well. So in my opinion, Singapore properties would always be easier to find tenants as our economy is more stable and better as compared to the rest of the regions. Moreover, Singapore is a very compact country, so making all these properties a much more attractive or much more easier available for tenants to rent. So they also have a list of improvements ongoing for different properties, and that is the big advantage for big REITs like Ascendas. So they can afford to constantly improve multiple assets. As you can see, there's redevelopment and asset enhancement initiative, whereas acquisition under development, and also even an additional one of convert to suit. So this shows that even though they improve on multiple assets, the rest of the assets are able to continue distributing reasonable amounts to shareholders. However, one thing that I would like to highlight is with regards to the convert to suite in the US. The property will undergo transformation from office space to life science building. So this might have been one of the big red flags that we can see that results in big drops in share prices for US office REITs such as Manulife and Keppel Pacific Oak. Looking at this data from FDI Intelligence, this data actually shows the comparison between the office spaces and the industrial spaces. So what does all this chart actually mean? As you can see from the orange line here, which shows the vacancy rate, whereas the blue bar is called the net absorption rate. So this net absorption rate is by comparing quarter over quarter whether they have taken in occupied spaces or vacant out of spaces based on the tenants. So if the bar is negative, it shows that tenants are moving out or vacate the spaces quarter over quarter. Whereas a positive value would actually means that tenants are actually taking up more and more spaces in this sector. So this can be seen from the vacancy line, which for the office they are having more and more vacants, whereas for industrial the demand is getting stronger and stronger with lower and lower vacancy rate. So this it might be one of the reasons why Ascendas are actually converting this building from office to industrial, or you can call it life sciences building, which is a very smart thing and a very good move by the management, which I like a lot as well. After going through so many things, because Ascendas is always very big, so I expect to take quite a while to talk about everything, we will have a summarization of what we need to take note of for the next quarter. So firstly, we will have to focus on the occupancy of the UBIX next quarter to see whether there is any improvement or if any analysts question about the occupancy growth rate. Second, tenancy renewals, especially for Singapore properties. Third, the impact of interest rate on their distribution and seeing whether the impact will change in value as well. Overall, Ascendas sponsors and management are constantly making good decisions might be the main reason why they are still around and improving today as one of the biggest REITs in Singapore. This can also be seen in the dividend yields and share prices, with them being priced at a lower dividend yield, which means higher share price as compared to the rest of the REITs. There are definitely some short-term risks as well, as the increase in interest rate will increase returns from safe assets such as bonds, T-bills, and bank deposits. Therefore, this must be taken into account as the Feds continue to increase the interest rate. However, stable returns would be able to do well in the long run, as long as the REITs are able to manage their debts well. If you have listened till the end, thank you so much. I've recently created MIT videos on their earnings, as well as power of compounding through REITs in the last 2 videos. Please like, subscribe if you like my content, and do put in effort to go and read out more on the REIT before you invest in it. Thank you so much, and to the next video.